up, let's get right to these markets with our floor show. Joining me with a $670 billion in assets under management is Creative Planning President and CEO Peter Mallouk. Peter, great to have you here on this Christmas Eve day here for the markets. So look, I mentioned it, we're at record highs. If I'm nervous about getting into these markets, convince me still at these records that we have room to go higher.
There's always room to go higher. A lot of people are surprised about the stock market. They get nervous. They go, oh, this was a big year. I missed my opportunity. I'm just going to wait for things. But the stock market hits an all-time high about once every 19 days. We're not surprised when a can of Diet Coke hits an all-time high in price, or a meal at McDonald's hits an all-time high, or a flight on Delta Airlines hits an all-time high. But we seem to be surprised when the stock market follows. Stocks just follow earnings. Inflation has been a big part of that. Strong corporate profits has been a big part of that. Dropping interest rates has been helpful. Consumer sentiment up until recently has been helpful. There's a reason we're here. And believe it or not, when you're going into a new year, the market having a strong previous year is actually bullish. Your odds in any given year are about 3 out of 4 that you'll be positive, but they're actually a little bit stronger coming off a strong year. The momentum is a real thing. Not enough to be predictable, but not enough to exit the markets. I
want to talk about some of the outliers in your notes, but you also mentioned bond yields. Today, bond yields are well behaved, about unchanged. 417 to 420 is the range we've been looking at on a 10-year. But curious your thoughts as we think about a new Fed chair next year. Donald Trump, the president, put this out a little bit earlier. I'm curious about your thoughts. He says strong markets, even phenomenal markets, don't cause inflation. Stupidity does. I want a new Fed chairman to lower interest rates if the market is doing well, not destroy the market for no reason whatsoever. He went on to say that if a Fed chair disagrees with him, that person will not be Fed chair. Do you like an independent Fed? Do comments like these make you nervous? Or are you okay with this?
Well, I mean, look, the Fed is not what I want. The Fed's supposed to be completely independent. And regardless of your political persuasion, all presidents have desires for the Fed to do certain things. There are people that have lost elections because of moves the Fed made in election years. And we're coming to the midterms. Of course, Trump, like previous presidents, has things that he wants. All presidents want rates to drop. It tends to inflate assets, make people feel good. Their 401ks are bigger. Trump is just much more transparent and direct and threatening, frankly, about it, which, does not really help with this idea that the Fed is supposed to be independent. The reality is the Fed is supposed to do two things: help with full employment and basically to have modest inflation. We have more than modest inflation. Inflation is better than it was a few years ago. That's completely true. It is still too high. Lowering interest rates significantly in an environment when you have international stocks at an all-time high, U.S. stocks at an all-time high, precious metals at an all-time high, speculative assets still outperforming, it's adding fuel to a fire. You want stocks and commodities to perform because they're supposed to in a normal environment, not be subsidized by lower rates. Regardless, I don't expect big moves. They might get a break or two along the way in the next 6 months, but I don't expect a dramatic change either way.
I want to talk about some of the outliers because I feel like for me, this was a year of AI. Mag 7, it's always the headline. Oh my gosh, Mag 7's 36% of the S&P 500. We need Mag 7 to save us. But you talk about the outliers, the broadening, the industrialness of this economy. What do you like that is not the Mag 7 that I've heard about over and over?
Well, I mean, there's so many stories inside of the S&P 500, I think, that just might surprise people. I mean, you hear that the stock market had this incredible year. We're going to end the year probably between 15 and 20% gains, exceeding, by the way, every major bank's expectations. Again, you cannot predict the market. Don't even try. Total waste of time, shattering everyone's expectations. And international stocks performing much better, which was definitely surprising to most major analysts. But a couple things. One, almost 200 stocks in the S&P 500 are negative year to date. I mean, that is mind-blowing and shows the power of the winners more than offsetting the losers. A lot of people have talked about the Mag 7. 5 of the 7 of the Mag 7 have underperformed the S&P 500. The only 2 that have outperformed have been NVIDIA and Alphabet, Google. And they're leading the AI revolution. They've been some early signs that they may be winners here, but the rest have lagged. It has really not been a Mag 7 story. It has been an NVIDIA and a Google story lifting up that component. And they're so heavily weighted that it's really had an impact on the overall returns of the market. This has been a fascinating year. You look at the tariffs and the bear market at the beginning of the year that no one expected, and how the year is finishing. So many stories inside what looked like a straight bullish year for every stock. Not really the case.
Well, one of those stories is mid caps, small caps. Talk to me about that, because the bears always tell me a company's small for a reason. It's small cap for a reason. It can't scale. It'll forever be a small company. But the bulls say this is a 4.3% GDP and it could go up next year. Small caps do good in a growing economy. Where do you come down in that debate?
I mean, over the very long run, the evidence is clear that small caps tend to grow at a larger pace than large caps. I mean, just common sense, right? A small company, it's easier for them to grow in most environments. There are, of course, outliers, especially tech-based companies. But what you do have with small companies is they have a lot of debt, and they don't have a lot of earnings. They're in the early growth phases. And so they do much better in lower interest rate environments. I think if you're somebody that believes that interest rates are likely to drop, as Trump is pushing for, and by the way, the bond market is clearly predicting right now a couple of rate cuts, that it really eases the burden. It makes it easier. There's going to be more upside in those markets. I noticed at the top of the hour, you talked about the Russell 2000 starting to hit some all-time highs with frequency again. And I think we can expect more of that if the bull market continues.
Peter Mallouk, such a pleasure to have your expertise on days like today. Thank you.
Take care.